Traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a quick look at the disclaimers that I need to show you, I'll just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Our goal as well is to break down all the market jargon and complexities that you read about. So if you do have any questions, please do ask them along the way, and we'll hope to answer those as we go, or at least at the end of the webinar when it finishes. Okay, it's Wednesday, November 12th, just after 11 a.m. in London. So let's get to it, really. Here are the key areas that we'll look at this week in the next 30 minutes or so. We'll just check out how markets are trading currently. We'll check out the big theme about the US government reopen, which is kind of happening as we speak. We'll then look at some of the major central bank meetings. We'll also look at those stock markets as well, just before those major central bank meetings that we had last week. And then if we have time, we'll check out a few other currency majors. Cable, obviously, Aussie dollar, and we'll look at the dollar as well before, if we have time, looking at gold as well. Okay, first up, yeah, just the government reopening really, and how markets are trading at the moment. Asia stocks, they traded mixed really, with the region indecisive amid pretty light fresh catalysts at least, and markets really digesting earnings. We have had news out of the UK, really interesting, really, that there may be a challenge to PM Starmer, really amid fears, actually, among his closest allies that he is vulnerable to a challenge in the wake of the budget. That's according to media reports in the UK. Otherwise, European equities, they're pretty positive. Actually, Euro Stoxx 50 up at 1.1%. After the close yesterday, and gains of 1.1% as well on Tuesday, hitting a record high now. The FTSE as well, 100 in the UK, that hit a fresh record high yesterday and is pretty much consolidating around those highs. European equity futures, sorry, US equity futures, pretty strong as well after a decent close yesterday, and we'll look at that in more detail, with the Dow hitting a record high intraday, not intraday, record closing high, and the S&P and the Nasdaq futures pointing higher after the Nasdaq struggled slightly with technology stocks lower and Nvidia lower after SoftBank offloaded all of its position in Nvidia. Otherwise, the US government shutdown is in focus, of course. On Monday, just to recap, the US Senate approved a bill to end the shutdown of the US government, and that is expected to be rubber stamped by the House of Representatives today. The new bill will fund the US government through January 30th. Senate Republicans agreed on a vote to healthcare subsidies that Democrats wanted to be prolonged, but there is no guarantee that this will be approved. Otherwise, sort of more generally, typically the rule of thumb that every week of a shutdown subtracts 0.1 percentage points from the US GDP growth in the quarter in question, with the sum total of that lost output then recouped the following month. Arguably, actually, the economic hit from the current shutdown in the last week or so at least could be somewhat larger, given factors like the mounting number of air traffic delays. In terms of employment data, which is key for markets, of course, the BLS likely to be able to release the September jobs report pretty rapidly, actually. It only took 3 days after the 2013 shutdown ended, with data having been collected and compiled already. So I think there are reports now that if the government reopens on Friday, then we could get that September non-farm payroll report early next week. As for the October jobs report, kind of different scenario, really. No data collection having taken place amid the shutdown. That means that while the BLS will now send out the usual surveys upon reopening, they will be asking the population to reflect, of course, on employment conditions around 4 weeks ago. Naturally, that leads to concern over how accurate that data will be. Same applies then to the November jobs report, data for which is due to be collected actually this week, and which may also be delayed, of course, depending on when funding is restored. As I say, potentially reopening on Friday, September NFP at least, early next week, and then we'll have a drip feed of data and maybe some data on same days actually. So it could be very interesting, rather volatile, as markets assess how accurate that data is, and of course then when that data feeds through as well. Markets, well, global equities extended their gains yesterday, led by Europe. We did get macro data on the soft side actually. ADP print, the weekly print was negative, but the equity rally was not fundamentally supported actually by yesterday's data flow, at least. We saw the Dow up 1.2%, as I said, record highs, record high close, S&P up 0.2%, but then the Nasdaq, the tech heavy Nasdaq that is, down 0.3%. As I said, sort of touched upon, S&P and Nasdaq struggled slightly, concerns over still elevated tech valuations. That weighed on sentiment there. And Nvidia fell 3% after SoftBank, as I said, offloaded $5.83 billion worth of their shares. We also had CoreWeave that dropped over 16% following a cut to its revenue forecast. And AI-related stocks generally, they remain volatile, and that dragged that Nasdaq index down, while gains in health and energy stocks helped the Dow, rise 1.2%. Interesting, actually, the healthcare sector topped the performance tables, rallying more than 2%, clearly outperforming tech, while that declined on the day. As I've said, that kind of rotation, healthcare outperforming tech on a risk-on day, kind of underscores that the session was not macro-driven, as I've said, but rather driven by kind of idiosyncratic factors and sector-specific narratives. In Europe, for what it's worth, healthcare was the best performing sector, while utilities, the other traditionally defensive sector, was actually the worst performer yesterday. Again, rather unusual sort of rotation pattern, suggesting investors repositioning within defensives rather than chasing cyclicals. If we just pull up a couple of charts, first of all. So let's look at the S&P 500, which we have here. You can just see last week we dipped out of that sort of bull channel, the ascending bull channel, from the sort of May jump higher, if you like, but we touched the 50-day moving average. That's at 66.86 on the S&P, and we bounced off that, and we've had 3 decent days, and now back in the middle of the bull channel, really. So looking at all-time highs here at 69.20 on the S&P 500. Nasdaq, similar type of chart, really. Bull channel, dipped out of that, touched the 50-day moving average. That's now at 24,799, back into the middle, really, of that channel, with the all-time highs at 26,182. Otherwise, for the Dow, didn't quite touch the all-time high, just above 48,000 there, 48,040, but it was a record close. We didn't quite touch as well the 50-day moving average when we moved lower, but we bounced pretty close to it. That's now at 46,480, and then, as I say, that intraday all-time high just above 48,000 on the Dow. Just for your guide, if we just go back to earnings briefly, we've had virtually all of the big earnings now, apart from Nvidia, which I think release next Wednesday, so that will be a big risk event. But otherwise, if I just show you what was expected initially, obviously 8.8, that has been beaten now. Scorecard wise, for the third quarter, 91% I think now of S&P 500 companies have reported. 82% of those companies have reported positive EPS surprises, and 77% of the S&P 500 companies have reported a positive revenue surprise. So 82% positive EPS surprise, 77% positive revenue surprise. For earnings growth, the blended figure for the S&P is now 13.1%. And if that 13.1 is the actual growth rate for the quarter, it will mark the 4th consecutive quarter of double-digit earnings growth for the index. Initially 8.8%, now that's up to 13.1%, and again 4th straight quarter of double-digit earnings growth. This all came amid, of course, the Nvidia topping $5 trillion before that pullback, and of course we did have that pullback, I should say, just immediately. Well, we topped out in the S&P on the Fed meeting, which was seen as slightly mixed, really, with a rather divided FOMC, and we've sort of dipped below that now, but then have bounced back, as I said. And as you can see, as I showed you from the charts. Okay, let's move on from this then to just last week's main central bank meetings, really. First up, the Bank of England meeting. They held rates as expected at 4%. The vote, though, was split more dovish than expected, 5-4 in the vote on the MPC. Expected was even 7-2 or 6-3. Dissent came from Dingra and Taylor, expected, and Ramsden, somewhat expected, but also from Breeden, which was unexpected. That dissent has led to the decision being characterized as really a dovish hold, and that did spark some sterling pressure as well as gilt upside. The statement that saw a slight change to forward guidance, so only a marginal tweak. There was a significant focus on inflation in the report, with a large portion of the MPC, in particular, particularly actually Governor Bailey, emphasizing that the welcome September print was just one series and they need more data. And that point was emphasized by the only minor tweak to the CPI view on the updated NPR forecasts. In terms of market pricing, actually Bailey described it as a fair description. So pre-BOE, this pointed to 2 cuts and around a 1 in 4 chance of a third, or a terminal rate at just under or at 3.5%, and that pricing hasn't really changed too much, although we have had some recent data that we'll get into, which has boosted the chances of a December 25 basis point BOE cut. In the press conference, Bailey stuck to the script, really, doubled downing on the inflation forecast, or focus, sorry, and outlining that he has no view on a neutral rate, but sees current policy as still being restrictive. Overall, then, no major changes to the outlook post BOE, with a December cut still the base case, but very much dependent on CPI data and, of course, the November budget. The 5-4 split, though, does make it very likely, really. Markets are pricing that in now around 65-70% or so now for that December rate cut, as I said. But the vote or the decision, sorry, will hinge upon Governor Bailey, actually, really, is the swing vote, if you like, because you kind of think the other votes are relatively entrenched in their positions. It all kind of means, though, that yeah, data will be key. So we have the October CPI print on November 19, so next week, and then we also have the budget then on November 26th, a week later, and then the November CPI print, actually the day before the MPC Bank of England meeting. So that meeting's on the 18th, so we get the November inflation print on December 17. So yeah, key data points for the UK and the Bank of England's rate cuts, but it seems if we do get disinflation and this sort of idea of peak inflation now, with services inflation coming down, as well as then that pushing down core and then the headline, then we will get that December rate cut by the BOE. If we just pull up the cable chart, just bear with me 1 second. Not looking so good, as we have had, rate cuts bets increased, and that's took its toll on sterling really, which fell here to multi-month lows last seen in April actually. So that low at 130.10. We did get a little bit of a bounce with the dollar moving lower, but we've got up to that 38.2 retrace level, which you can see is fairly prominent actually. Held the upside, capped the downside really on a couple of occasions this year already in May, and then in August you can see. So we got below it and looked as though we could be pushing above, but no, we're now rolling over a touch. So just watch out for that. That's a 131.40, that 38.2 retrace of this year's rally essentially. So a major Fibonacci retracement level. Below that, then we have that low, as I said, at 130.10, and then the halfway point of this moves at 129.41. Otherwise, above, you do have the black line, the 200-day moving average at 132.71. Just looking at sterling elsewhere as well, struggling against the euro. You can see this is euro sterling, and we're just challenging now those recent highs at 88.29. If we do break that, then let's go long term, and we're getting up to probably levels from April 2023 around 88.75, and then some of these swing highs 89.24, and then January 2023 high at 89.78. That is if we do break that near-term resistance in euro sterling. Another couple of sterling charts as well I might as well pull up, and of interest really. Sterling yen, sorry, just pushing up now above 203 really, and 204, sort of 205 is resistance there. But sterling Swiss I wanted to look at, moving lower and really down to sort of all-time lows. If you take out this spike low, which was of course the Liz Truss chaos, that spike low, if you take that out, then we're on to all-time lows in sterling Swiss. And let's just pull that back. That spike low was at 101.56. We're nowhere near that at the moment, but we have broken down through just recent lows really on sterling Swiss. So interesting move lower, break to the downside, as really well as a combination of Swiss franc strength really on hopes of better terms of trade with the US, and then of course sterling weakness. And we'll get to some of the more recent data points very soon. In fact, let's look at the RBA then, and then we'll come back to the UK. So let me just pull up a couple of RBA charts next up. Yeah, we had the RBA last week again. They also left their policy unchanged at 3.6%, widely expected decision really after the recent higher than expected inflation data. Basically, the bank, they took notice of that Q3 trimmed mean inflation accelerating to 1% Q on Q and 3% year on year in the September quarter. It was 2.7% in Q2, so materially higher than expected. Headline inflation also increased above the 2 to 3% inflation target range at 3.2% in Q3. And even as really the bank assesses that the part of the rise in underlying inflation is due to temporary factors, a new forecast now sees inflation rising above 3% in the coming quarters, before then settling at 2.6% in 2027. And that scenario is based on one more rate cut next year. On activity, the RBA indicated that the pickup in demand continues and that the housing market strengthened further. Labour market conditions were assessed as being tight, even as the unemployment rate rose from 4.3 to 4.5%. Then on the monetary policy stance, the RBA said there are uncertainties regarding the assessment that monetary policy remains a little restrictive. Given recent evidence of more persistent inflation, though, the board judged that it was appropriate to remain cautious, updating its view of the outlook as the data evolve. The reaction really quite modest. We saw 3-year Aussie government yields rising a touch, a few basis points really, and money markets still see relatively decent chance, around 70%, I think, of one additional rate cut by the middle of next year. Here you can just see then interest rates 3.6% and inflation moving above that band, the 2 to 3% band there. So potentially on hold for a prolonged period, really. If we get just pull up Aussie dollar then. Just stuck in a range really, with yeah, in the range 64, 66 sort of thing, with a break to the upside, but that didn't last too long. We've got the 200-day moving average just below at 64.52, and then we have the 50-day moving average, the blue line, at 65.58. We do get labour market data out overnight, which could be of interest. Expectations are for the headline jobs to print around 20,000, so just a touch above the 14.9 thousand prior. Unemployment forecast to move 1/10 lower to 4.4. Employment growth has been easing as various economists cite a rebalancing of or between the different sectors in the economy. So yeah, bottom side capped by the 200-day at 64.52, upside the 50-day moving average at 65.58. Otherwise, as I said, we do get UK data as well on Thursday, the GDP data. Consensus expects a reading of just around positive growth, 0.1% in the third quarter. This has moderated, of course, from the stronger first half of the year, which was boosted really by tariff front loading. Growth in the new year, looking forward though, is predicted to slow as government spending slows, and it will all be about the 26th of November budget really, and how markets respond to that. At the moment, growing political unease really, with one cabinet minister potentially throwing his hat in for a leadership challenge, although he's obviously denied that, Wes Streeting that is, but real political tensions increasing in the UK, which may reverberate in the markets unless the budget could be received quite well by markets really, but then if the Labour Party do not really receive it as well, then that could affect markets going forward. Otherwise, other data we have had out of the US, we had that ADP data I touched upon, actually published its new weekly 4-week employment growth estimate, and that showed a decline of 11,000 jobs. That contrasts with the stronger than expected monthly reading of plus 42,000 released last week. And while the estimate lacks sort of detailed explanations, it does suggest that job growth momentum may have weakened towards the end of October. And that could be an issue going forward, of course, when we get some of this other data very soon, potentially next week at least, with that, as I said, September non-farm payroll report. Otherwise, we got small business optimism survey out of the US as well yesterday. That came out on the dovish side, and again, labour market data were less changed as indices reflect hiring plans and labour shortages remaining mostly steady actually. If we just look at then, let's pull up the dollar, a couple of charts to finish off with before looking at gold. So we've got the dollar index here. Capped, the upside capped by that black line, which is the 200-day moving average. Let me just pull up the chart for you. here. So that it comes up at 100.16, and then you've got just a minor fib level of the this year's decline, actually at 99.51. We're trading around that, and also a long-term swing low from 2023, that's at 99.57. If we do break down, then you've got the 50-day moving average at 98.48, which is the blue line below. Otherwise, euro dollar, let's look at that as well. Similar chart if you flip the DXY on its head, because the big weighting in that 56% or so is the euro in the DXY, just to remind you. Euro dollar then, yeah, we've got 23.6 of this move higher. That's a 115.07, which capped the downside. But yeah, near-term fib levels. You've got the halfway point of, is it the halfway point? No, it's 61.8 of this move higher from August to September. That's a 115.92. Could possibly cap the upside, so that's resistance. Otherwise, the 50-day moving average, that's a 116.61. Okay, just moving on finally to gold. If I just pull up that chart. Interesting, obviously had a massive ramp higher. Up to 43.81, and then the biggest one-day sell-off in many years, actually. We came back down to 4,000, just below 4,000. Sort of 390, where were we? 3,925 or so. That capped the downside, traded around that and 4,000 before then pushing higher on Monday. As really there were worries about the US fiscal situation again, certainly with this announcement that potentially there will be $2,000 dividend checks going out to low-income families potentially in the US, and also, yes, anyway, that was one reason cited for this big jump higher in gold. So we moved up through 4,000 quite strongly. So next levels 41.66 potentially and 41.73. Yeah, there were worries, as I say, about those tariff dividends, with the deficit near 6% of GDP, really sharpening concerns about, well, policy inconsistency and really debt sustainability. Of course, we also have potential rate cuts coming from the Fed, with a pretty high chance then of the December rate cuts, 25 basis points really priced in. Our market's looking forward to that. And then, of course, a potential end to the shutdown potentially, well, helps clear that way for the Fed rate cut, and as well puts the spotlight, as I've said, back onto the US fiscal trajectory, and an issue that markets are finding increasingly difficult to dismiss. That all plays into the hands of gold bugs. So yeah, near-term upside eyed targets 41.66, 41.73. Before then, the record high of 43.81. Okay, I think we'll wrap it up there, actually. Yes, not as long as normal, but certainly a lot of things going on. And certainly if we get market data out, US labor market data out next week, then we'll be much busier as well. And then, as I said, we have NVIDIA earnings to look out for, and then also some UK data as well, to gauge how the Bank of England rate cut bets are going ahead of then the November budget in the UK. So lots to look forward to. Please do tune in same time in a couple of weeks' time. Okay, take care, and we'll speak to you soon.